In this example problem, we are going to create a liability for a future asset retirement obligation. So there are assets that you can acquire where you're going to use them for a point in time, but at some point when the useful life of those assets end, you're going to have to pay some additional costs to properly decommission, get rid of, etc. that asset. And in our example right here, we are the Midnight Minerals Mining Company, and we are operating a new mine. Over a period of time, in the case of this problem, our useful life is 10 years, so over 10 years, we're going to continue to take ore, silver, whatever it is, out of this mine. And when we're done, when the mine is fully extracted, we can't just leave a big gaping hole in the earth. That raises a very big safety concern for any children, animals, whatever that might venture into there. We're going to have to properly close and seal off this mine to ensure the safety of everybody that lives in the general area of this mine. And that's going to cost us $2 million. The problem is we can't put a $2 million liability on the books. We really don't want to put a $2 million liability on the books because that's not $2 million in today's money. And all the other stuff that's on our books is in terms of what's going to cost today. Like our accounts payable liability is what we have to actually pay in the immediate future to close this off. Well, this isn't in the immediate future. This is way, way into the future. So step one right here, what we need to do is we need to figure out what is the value in terms of today's dollars of $2 million that has to be paid 10 years from now. And to do that, we're going to have to find out the rate that we're going to discount it at. How are we going to decrease this from future money to today's money? And there are two options that are pretty commonly accepted. The first is the risk-free discount rate. So that is the rate that the government, the U.S. government, offers on long-term bonds. And in this case, that's what we're going to use, which is 3%. Another option, too, is to take the estimated rate of inflation, which you can also readily find from any database that you want, and discount it at the expected rate of inflation. But we're going to use the risk-free discount rate right now on a 10-year U.S. bond, and we're going to use the PV function to convert that $2 million 10 years from now into today's money. So in requirement 1, what I'm going to do is I'm going to use the present value function. So I can hit the FX button in the cell that I want, and it's going to ask me what one I want to find. I'm going to type in PV, and I'm going to hit go. And it's the first function that shows up, so I'm going to hit OK when it's highlighted, and it's going to ask me for a bunch of inputs. The first one it asked me for is the rate. Well, let's use as the rate that risk-free discount rate of 3%. NPER is the number of periods that this rate would be earned on. If it's 3% a year for 10 years, our number of periods, our NPER, is going to be that 10. PMT is a periodic payment. Now, if we were paying $2 million per year for the next 10 years to decommission this, I would use the PMT area of our function right now. But that's not what's happening. This is one big lump sum that we're going to have to pay in the future. So we don't need to fill in the PMT portion. What we need to fill in is the future value portion. And that's going to be for the $2 million that we have to pay 10 years from now. Excel does this thing where it loves making numbers negative. So what you're going to do here is make this negative $2 million. Basically, we're going to have to decrease our cash by $2 million 10 years from now to decommission, seal up, safetify, if you will, this mine. And when I hit OK, I come up with $1,488,187.83. This is going to be, in terms of today's dollars, the cost of sealing off this mine 10 years into the future. Well, when we put the mine on the books at the time, we're going to put it on for all the costs that happen. I'm not going to put all of them on there right now, but anything we would have to pay for the land, setting it up, whatever, it goes into the historical cost of the mine. Well, this is also an expected cost of the mine, which means we get to capitalize it to the asset that it's tied to. So my debit in this entry is going to be, I'll just call it mine. If it was for a building, it would be to buildings. We got another example coming up later that's going to be to a thing called leasehold improvements. Whatever asset you have that's going to cause you to pay this expense in the future, the expected cost of it in terms of today's dollars goes into that asset at the time that you're putting it on your books. Now, what is my credit going to be? Well, this is how much we are liable now to pay 10 years in the future, because we have to properly seal off and close this mine. So I'm going to credit this to an account called ARO liabilities. And that is a liability account increase, an asset retirement obligation. In terms of today's dollars, we are now obligated to pay just under $1.5 million 10 years into the future. And you shouldn't have dollar signs in journal entries, so let me get rid of those. There we go. And we're going to capitalize that and put it on the books at the time that we're acquiring this mine on January 1st of 2023. And down here we capitalized the PV of ARO obligations to mine. So this isn't the full cost of the mine. This is just the extra cost for this future expense that we're going to have to pay to decommission. And then as time goes on, we're going to have to make adjustments because this is going to get closer to that $2 million as we get closer and closer to retiring this thing. So down here in requirement 3, we have the first year ending. We put this on the books on January 1st of 2023. It's the end of 2023. We got to figure out now, in terms of today's dollars, what would the present value of it be? And it won't be the same number because this one was expecting it to be 10 years into the future. Well, now all of 2023 has passed between January 1st and December 31st, which means it would only be 9 years in the future. But we can use the same steps that we did before. We want to use the PV function, so I'm going to go up to insert function one more time. And I'm going to grab the present value function. Our rate that we are discounting at is still at 3%. But the NPER is going to change because now we have to pay it not 10 years in the future, but 9 years in the future. It's still not a series of periodic payments, so we'll skip the PMT function, and we'll go down to the future value, making that $2 million negative. So we should look a little something like this formula has down here. And I'm going to hit OK. And this makes the present value of that $2 million, which we now have to pay 9 years in the future, $1,532,833.46. So to make an adjustment in here for the change in our asset retirement obligations that we have, we got to figure out how much the present value of this obligation changed during the 2023 business year. So what I'm going to do is I'm going to take the present value of the retirement costs at the end of 2023, which is what we just calculated here in requirement 3. I'm going to take the present value of what they were at the beginning of 2023 when we capitalized this ARO liability to our mine. And now I'm simply going to find the difference. If the present value is now $1,532,833.46, and it was $1,488,187.83 at the beginning of the year, that means that the present value of this future retirement cost, which I have a typo, let me go fix that really fast. Let me just throw an E in. Oh, never mind. It doesn't want to do it. And there we go. Triggered me over here. That future retirement cost has increased by $44,645.63 during the year. Well, we should be carrying this ARO liability at its present value at all times, which means this needs to increase by that amount. So for the credit in here on the second line, that's exactly what I'm going to do. Once again, I'm going to debit ARO liabilities to increase that amount by how much it went up during the year, which was $44,645.63. What is my credit going to be to? I'm going to use an account called accretion expense. And in accounting, the term accretion refers to the periodic increase in the value of either an asset or a liability, in our case, a liability. The liability isn't being carried at what it's going to cost us in the future, it's being carried at its present value. Well, the present value of that liability just increased, so we need to accrete this $44,645.63 to our ARO liability, which we're going to do in this December 31st entry, where we adjusted mine ARO to current PV. And one incredibly useful tool that you can have when it comes to the time value of money in accounting is to carry your asset retirement obligations at their current present value. I mean, look just right here with the numbers that we have. Zoom out a little bit so I can get it all on the books at once. This would be $2 million. If we put this at the end of the year on the books for $2 million, instead of the current retirement cost, it would be carrying it a little over $1.5 million. That's like $500,000 of debt that would show up in our books, would affect our debt ratio and all of those things. that doesn't really exist this time. So using this methodology allows us to minimize the amount of liabilities that we have to report, and it also allows us to record the expense related to this mine, the accretion expense, in chunks over the amount of time that we're going to actually use the mine, instead of just having to record one big blast $2 million expense at the end of the life of the mine, where it would have a 1 year very negative dip to our income. So accretion is a tool that you have, in this case, when you have a liability that's not going to be due till years and years in the future, to help smooth out your earnings, to help your books properly represent your true financial position, etc.